So I'm joined today by John Kaiser, who's the editor and founder of Kaiser Research and a 30-year veteran of junior resource sector. There are a few people who follow it more closely than John, and I'm very glad that he's agreed to have a conversation with us. Thanks for being here, John.
Tommy, it's great to be here with you.
So the other day you gave a riveting speech to the AME-BC, which is BC's mining lobby, and I think it caught a lot of people by surprise just in its objective negativity about the reality of the sector right now. So what do you think are the most important points of your presentation from Tuesday?
Well, there is this belief out there that this is just a cyclical downturn, and we just need to be patient and perhaps hibernate for a little while, and then the cycle will turn up and everything will be good again. But the point I was trying to make is, yes, it is true that this is cyclical. What we don't know is how many years we may be here in the cyclical trough, but what has happened are structural changes in the industry which have wiped out the retail aftermarket, which has further undermined the accredited investor private placement financing mechanism, and with other changes in the brokerage industry where the broker or financial advisory as an intermediary is coming under the orbit of the client relationship model, where most high-risk junior companies are unsuitable. We are losing the access to capital. And the big change that needs to be undertaken is that the accredited investor restriction must be eliminated for accounts where there is 100% responsibility, where there is no compensated intermediary, and where you do not need to be worth $1 million in order to put money directly into a publicly listed company which is in full compliance of this rather substantial regulatory burden that has been created, which incidentally is an asset because it makes what the companies are producing and publishing and reporting reasonably reliable. This change needs to happen in order to allow the earlier stage exploration to deliver the new discoveries that we need in a period where there may be not much help from significantly higher metal prices to create the sort of momentum and upwards revaluation of existing projects. We need to bring the discovery part of the exploration and development industry alive again. The reason valuations are not going up is because we have an alienated retail audience which does not know how to quantify the potential outcome of a successful discovery that becomes a mine, and because we now have a trading culture on steroids in the sense of prop traders using perhaps just themselves or even computers are able to come into these markets, sell on a downtick, not even borrow the stock because they are using specially designated day trading results. So if there is any sort of retail investors' capital coming into the market, they stand there competing with the existing shareholders, and they literally intercept this capital inflow and strip it out and do not recycle it. And so the so-called accredited investors who do these private placements, they are finding that this sector is turning into the sort of a lottery ticket that it is when you invest in a private company that is doing exploration. And so there is even a sense that, well, what do we need this regulatory burden and all the restrictions it creates if the existence of a public market is not helping us to raise money and reward the higher risk taker insofar as the fundamentals are delivering in a successful manner? Maybe we should just delist and forget about these public markets and operate in an unregulated market and just
And what's so bad about that?
Well, the bad part is that exploration and development is not what it used to be. The universe will shrink to 500, 600 companies, even if gold pops to $1,800 tomorrow, because the experience of the past decade, which you lament, has also changed this space. The degree of professionalism that did enter the sector, even though there was all this pretend pseudo-professionalism that accompanied it, it has raised the bar in a way that will not go away. when the tide rises, most of the boats are going to be tethered to the dock and are just going to hang there and go nowhere. So I agree there's been a lot of mismanagement, but there's also been excellent management, and we are now seeing a winnowing of the wheat from the chaff.
I want to know what you would say to a retail investor then who's disenchanted. Why should they care again, or should they care at all?
Well, one of the things about the mining industry, which turned into a negative for it during the dot-com bubble, is that when you look at a project, you can quantify its upside limit. You can say the deposit's going to be so big, it's going to have such and such a grade, have so many ounces, it will be depleted in 10, 20 years. You can do a discounted cash flow valuation, come up with a number of what this is worth right now. And that became a negative when you had a dot-com company, which conceivably could be the winner-take-all that inherits the entire cyberspace. So the sky was the limit. Retail audiences should take a look at the resource sector space precisely because of the finitude of the upside potential. You can quantify the success potential of an exploration play much more effectively than you can some new medical device or some new mobile app and all that. These things are all benefiting from a giant momentum that's on the upside. This momentum is peaking right now. This will all be descending into the garbage can over the next 5 years. And during this period, people who want to make high risk, high reward bets should be looking at the resource sector. But that's why, as I suggested earlier, we also need to make it easier for the retail investor to put money directly into corporate treasuries, not just buy existing shares in the market, which often are shares that don't even exist because it is just these prop traders short selling into the market. We need to have the individuals be able to go directly to the company through a mediated system where, for example, ABC company decides to do $1 million financing at 10 cents, submits it to the stock exchange, they approve it, yes, you're in compliance with everything. It shows up in the system of all these 100% responsibility accounts. You log on in the morning, you see, oh, there's an offering available. Becomes a first come, first serve thing. You do your homework, you say, okay, I want to do 10,000. You do the push the button for 10,000. 10,000 immediately gets swept out of your account. You have a 2-day buyer's regret window, just in case you drank a little bit too much wine the night before when the promoter was talking to you, and when before you went to bed, you went and you can uncommit that thing. But after 2 days, it's committed. The system tabulates how much is there. When it closes, when the limit is reached, then it's over. It gets swept. The money gets swept to the company. The certs and warrants get swept into the client's account. A 4-month hold thing starts to tick, and a processing fee, maybe 0.2, 0.4% gets charged, rather than the 8 to 12% that the conflict of interest soaked trusted intermediaries have been socking the companies with through the private placement mechanism in the past. So this allows and if you eliminate the accredited investor rule for these people, then all of a sudden you have a much larger pool of many small investments. Because frankly, if you want to gamble in the juniors, you need to have 10 different stocks to diversify that risk. Because if you think you're going to be able to pick the one stock that's going to be the home run, I guarantee you that you will lose big time.
Okay, so I love your idea. Right now, you pay an enormous amount to a broker. If you're investing directly into a private company or public company, you're probably paying, like you said, 7, 10, 12% in fees.
Well, not the client. The company pays that much. So and then they have the regulatory burden too of all the ass covering legal stuff, so that the broker can't be sued. So there's like an enormous portion of money raised that's diverted unnecessarily for basically litigation mitigation.
And I mean, so you've got your fees to the underwriters, you've got your fees to the regulatory system, you've got your management focus on that that draining focus away from the exploration, away from the R&D, and so I'd say that, you know, the true number that's reaching the companies is it's probably, I don't want to be hyperbolic, but it's half of the dollars that are being invested are spent doing the work that the investor thought that they were paying for. What will become of Canadian speculative brokerage community, do you think?
I think the brokerage community is history. The roles that they used to play are no longer viable.
All right, well, we're cut short for time, so I just want to say thank you so much for being here, John, and this is very fascinating talking to you as always.
Thank you, Tommy. It's
Much
been great.
appreciated. So it's kaiserresearch.com, and I certainly am a subscriber, paying one at that, and recommend that all of the CEO.CA readers who are interested in the Canadian junior resource sector should check it out. Thank you, John.
Thank you.